All right, ladies and gentlemen, I hope you had a wonderful weekend. We got a fairly eventful week ahead this week, but given it is halfway done with the year, we have earnings right around the corner. We got to talk about some of the biggest trends this year and why the recession odds have absolutely tumbled. So we got a couple of big things. I have the plays, I have the keys, all of that, but we got to talk about some of the recent trends, because if you haven't noticed from the beginning of this year, this little bottom chart right here, that is your no landing probability. And now halfway done with this year, it is heavily increased from last year. And now we are entering the lowest probability for a hard landing that we have seen in probably the last 2 or 3 years. So we got a lot to talk about. We still have earnings right around the corner. There's only a little bit of data this week. I got a bunch of cool charts that we got to talk about. Most crowded trades, all of that good stuff. The plays, the keys, all of that. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open. YouTube.com/The Stock Market. We will see you there in the morning, baby. Run it.
Working to the couch, it's the 2020 election. Live in the hills, but still get a spread. Started with a live, but it's still reinvesting. Feel how I feel, then you feel like it's a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
All right, off the bat, before we get into any of these trends we've seen in the last 6 months to start off the year, we got to talk about what we're getting this week, and it's not going to be that much. Now, maybe I get surprised, but it'll relate to some of the other theories I'm going to share with you today, but it should be relatively calm until Friday. We get the PC on Friday. That should be the main event. There will be a lot of other real estate data throughout the week. You'll get durable goods, manufacturing, and I think GDP on Thursday, so there will still be a lot to digest, not to mention overseas, everywhere from Argentina to other places in Asia. You will be getting data and CPIs, and if you remember, the last 2 weeks, we've actually gotten some big moves from overseas data, so all of that's going to factor into what we're dealing with. You also get to sprinkle on all of the Fed speakers, but for now, I don't think any of these data sets are any different with what we have dealt with these first 6 months, because as we're going to talk about, it's going to take a lot to change people's minds, meaning if there is no real monster moving data, and there shouldn't be, and even if there was, it seems like everybody is kind of holding to an idea, and we are still riding that golden path. So why I'm saying this all, just imagine, it's been halfway through this year. You've gotten a lot of data. Even last week, we saw a little bit of back and forth, good data, bad data, bad data, good data. No matter what, every other week, every other month, the market's hitting a new all-time high. I think NVIDIA finally had its first red week in about 3 months. So, the point is, everybody is kind of holding on to some of their ideas. So let me not waste any more time. This is what I really want to talk about, because so far to start off this year, you have people falling in line with a lot of these beliefs of soft landing, no landing, and currently the odds of a hard landing, that is the lowest that it has ever been. So according to the Bank of America Investor Survey, it's that picture that I showed you, and we'll go back to it, but there's a little bit more details behind it, but 73% of investors who were surveyed believe there will be no recession, 26% believe there will be a no landing scenario, and only 5% believe in a hard landing scenario. Here's where it gets even better. You just had the Fed dot plot. You just had them say, well, we're only going to do one cut, and you saw how the Fed futures disagreed. Well, 80% of investors believe in 2, 3, or more rate cuts this year, with a majority believing they will occur in September. Otherwise, the next set will be in December. And then the most crowded trades right now, the number one concentrated trade, I think with about 68% of fund managers saying they're invested in it, it is long Mag 7. Number 2 is short China. And then number 3 is going long on gold. And then the fourth trade is long the US dollar. So why am I telling you all of this? Why am I showing you this? Because the point is, after this last 6 months of data that you have gotten, people are not changing their mind. This whole idea of more time and the data going how it is, you have literally had this year increase the odds of no landing more than any other year. This whole concept of, oh, no landing, we love it, we feel it. Yeah, that's a 2024 thing. I don't know if you believe me or not, but you could even go back, go find the Bank of America Global Fund Manager survey and go back. This is where the no landing odds started to creep up. That is all recent. You even go look here, this whole soft landing, that's pretty much been the same. That's the crazy part about all of this. And really, it's just been a matter of the people who were believing in a hard landing, they were shifting to the no landing, or maybe your soft landing camp went to no landing as the hard landing guys went to soft landing. But the point is, this trend for the last 6 months, it has been holding up, and people don't want to change their mind as much. So that was a big thing, and I really hope this factors into everything, because it's like, hey, equal and opposite reactions. If you don't get a real shift in Powell or the data, and unless we get an external shock, people are just going to keep riding this until it actually occurs or it doesn't. So keep that in mind. That's the first thing I wanted to show you, but there's also one more thing, or I got 2 more charts, but the second one here, ironically enough, even though you've heard about money markets and everybody feels this way, I mean, look at this chart right here. This is showing you from the fund manager survey. That's what FMS, and it's saying these fund managers, they have the lowest percent of cash than they have had since what? I think around like 2013. And if you even go look, October 2022, we got a little bit of meta and some of those other things. Everyone's getting worried about the rate hikes. You had a lot more fund managers holding on to cash. Well, right now, that is not the case, and you're actually reaching a pretty low percent. So whatever you think is happening here, I mean, those fund managers, they're feeling a certain way, and they are buying, and they have been, or at the very least, they're not holding as much cash and as defensive as they were almost about 2 years ago now. So that was the second one. And then the final thing I was going to show you guys, the most crowded trade, but this is going back 10 years. So you could see from like 2014 to 2018, again, these whole crowded trades, it usually flip-flops. So it's not like it's one thing, like even 2020, long U.S. tech stocks, a little bit March 2020, long cash. And since what? April 23rd till now, long big tech, and then really beginning of the year, the long Magnificent Seven. These are the most crowded trades here. So we'll go over this one on stream, but the point I'm telling you guys is we have a very interesting week ahead. Things are both quick and slow at the same time, but unless you're getting real major changes, and you shouldn't, a lot of people have made their mind up, and the last 6 months has solidified this path that we are on. It's either you come to fruition and good things happen, or an external shock hits, and then, we get to recalibrate and do all of that. So keep that in mind. But the final key, man, all of the data, all of the expectations here, people don't want anything to change. So why I'm telling you this and showing you all this, it's not so that you can be biased and make up your own mind, but I'm trying to say, control your expectations here. We are entering summer. It shouldn't be that fast. The volume has already been low. It's probably going to stay low till Labor Day, September. And with everything going on, it's like people don't want to change their minds. I mean, if anything, people love to cling to the optimism here, and you haven't had anything bad happen. So what I'm trying to tell you is I really wouldn't expect much from the trading front unless we get an external shock or something that will externally confirm all dandelions and roses and all of that. But for the most part, it should be very slow this week. Like I'm saying, the data will be punting till Friday. I'm not expecting much. And even if we do get a little bit of the back and forth data, I would not expect that to cause a fundamental shift in the market. And we're probably going to have to wait till Labor Day. Again, even September, the rate cuts and all of that, man. We'll see where that all takes us. But now, let us get into the plays. So, right off the bat, I do think this week should be pretty straightforward, but the first play that I got to start with, even if we don't get moves this week, depending on how fast or slow you should start thinking about earnings. So as we enter in July, we still got to wrap up this week in June, but before you know it, earnings will be there. Those big tech names, it's going to start off with the banks and Netflix and Tesla, and then now the chip makers and all of that. I think this is going to be a big deal, but the first play I'm putting up here is Intel. I was looking at this for the long term. We already added some not too long ago. I still got a deposit. We got another one right around the corner, but I was looking at Intel and I was like, man, this thing does not really stay pinned as it has. This only happens a couple of times where Intel actually like drops and then holds a floor to a degree. So I think they can go lower, but here's the play idea. I think I'm very early on this, but you should keep this idea on your list. Watch for Intel pre-earnings. Last time stock was pinned, I want to say it was like, 2021? Or 2022, but last time I had the pin here, pretty much it'll just go crazy ahead of earnings, and then it died. So, I'm not saying that this stock is going to recover completely and turn into green, but I am saying if it does not move for the next couple of weeks leading into earnings, I would not be surprised a week or two before earnings, it starts to take off, and then after earnings, it'll do its thing. But that play really stood out to me. I kept looking at it for the long term, so thought we would throw that one up there, but that is play number one. Then play number two, Delta and Airbnb. So why I like this is hot stock summer, baby, but travel trends are doing good. I don't know if you guys realize, since I was like, I love Airbnb and travel in 2020, travel is year after year just doing very good. Although people get worried from time to time about demand and the analysts play that weird game, once again, travel trends are looking good. You are about to enter even the busiest travel time for airlines, I believe, the week before and after 4th of July. I think expected traffic's expected to go up 5% than last year. So all of it's looking good. And I think here over the next couple of weeks, maybe things are slow, but you will start to get travel headlines, I think, from either companies or just hear about the industry. This should be a driver. So pay attention to any outperformers, underperformers. Delta, that's probably the better airline. Airbnb, I like, but don't forget Booking. I even think they're at 4,000 or 3,900. So a couple of those travel names are also still doing well as well. So watch out for that. That is play number two. And then finally, play number three. This one, don't get too crazy, but this was an idea that came up and people are talking about it related to the hard landing stuff. And the idea is long bonds. Why? It's kind of like that oil trade I told you about 2 weeks ago. And hopefully you noticed that play went absolutely insane because oil was a cheap risk hedge. The risk premium on oil was not high. So sadly, that's already moved up. And then even bonds here lately, it has gotten a bit over the last 5 days. But people are saying the same thing about bonds now. It doesn't have the same geopolitical stuff and floor that oil would have. But people are saying that if hard landing odds are so low, then by default, that means that the bonds are not pricing in that much. So bonds are kind of cheaper on the risk side as long as people think a hard landing will never happen and keep throwing their chips on the whole no landing, soft landing. So watch out for that. I don't have any plays on it, but kind of like we saw the oil trade develop, see where things are, compare it to gold, copper, other commodities, and we'll see where that ends up when it's all said and done. But the bond ones, again, unlike oil, bonds, you got to worry about duration risk, whereas oil, you kind of get seasonality to drive it up and down regardless of how you position that time. So watch out for that. Those are the main plays. As far as everything else, I made a couple of plays on Friday. I grabbed an AMD weekly next week, actually, so I'm still in it. Spent about $20. I grabbed a 187.5, and my logic was AMD was the underperformer of the chips over the last couple of weeks. We had the big expiration. I thought we would move more, and we did not. I don't know if you guys saw what happened on Friday, man. You did absolutely nothing on the biggest expiration. So maybe these next few days we'll get more, but this is kind of word to what I'm telling you. Dude, people don't want to change their mind. They are loving the hard landing or the soft landing, no landing. Why would they change their mind? Even if the data, you've had 6 months of both good, bad. You've had dot plot shifting, fears, all of this, they're not changing their mind. So even yet Friday, that big expiration, we had no real reaction. The bonds kind of did move, but that's why I decided to go for AMD. I was like, hey, they're the underperformer. Maybe we'll get a craziness on Friday, but kept it small. Still got a little bit of time, but that did not work out. I think that one went down about 50%. That was a horn. And then the other play, gold, it was up a lot. It was up 1% and then flipped after the data. So this is the weird part because equities aren't reacting, and then every other day you're kind of getting a bond, dollar reaction, gold, commodities to what's going on. So I still like the gold play from the SMB cuts and everything last week. I decided to make another average down and grabbed another MGC at 23.39. I think my average price now is like what? 23.47. So I was green, and then that flipped red, and then went green, and then flipped red again. So we will see where that will take us on Monday. But those were the only other plays that I made. As far as everything else, no, that's it. That's all I got for you, baby. And now it is time for our economic lessons. So if you weren't there on Friday, what we are going over is industrial substitution, but we got to talk about pretty much how societies in a lot of the developing nations that got to grow a lot over the last couple of years, or 40, 50 years, why they started one way and then why they shifted to where they're at now. And really, the thing I like about this lesson, we are going to talk about a lot of history. So it's a little longer today. I still got to update the playlist. If you're not familiar, if you go to this channel, there's a playlist that should say 2024 econ lessons. And then, always as a reminder, if you don't know, anytime I interrupt here, that will be my opinion. So big shout out to y'all who have been paying attention and been a part of it. But let us continue with import substitution and industrialization part 1. We are now at domestic interest, international pressures, and protectionist coalitions. Developing countries' trade policies underwent a sea change in the first half of the 20th century. Until World War I, those developing countries that were independent, as well as those regions of the world that were held in colonial empires, adopted liberal trade policies. They produced and exported agriculture goods and other primary commodities to the advanced industrialized countries and imported most of the manufactured goods they consumed. Governments and colonial rulers made little effort to restrict this trade, but by the late 1950s, those liberal trade policies had been replaced by a protectionist approach, those that dominated the developing countries' trade policies until the late 1980s, and whose remnants remain important in many countries today. We begin our investigation of developing country trade and development policies by looking at this initial shift to protectionism. Trade and development policies in developing countries have been strongly shaped by political competition between rural-based agriculture and urban-based manufacturing. Developing countries pursued liberal trade policies prior to World War I because export-oriented agriculture interests dominated politics. In general, developing countries are abundantly endowed with land and poorly endowed with capital. So that's something you guys should have already learned by now as we've gone through in the earlier chapters. I like how it reiterates it, but none of this stuff should be new of how we got here. The relative importance of land and capital in developing country economies can be appreciated by examining the structure of those economies, together with exports as presented in Table 6.1 and 6.2. For the time being, we will focus on 1960, as this will allow us to put aside the consequences of the development policies that governments adopted during the post-war period. With a few exceptions, particularly in Latin America, between 1/3 and 1/2 of all economic activity in developing countries in 1960 was based on agriculture, whereas less than 15% was based on manufacturing. By contrast, agriculture only accounted for 5% of gross domestic product in the advanced industrialized economies. If we include the other industry category, which incorporates mining, then in all regions of the developing world other than Latin America, agriculture and non-manufacturing industries accounted for more than half of all economic activity. So again, it's going on, and it's showing you here this chart, economic structure, sector as a percentage of GDP, and you can even see it over the years and how it's changed. And even to this day, you know, the quote-unquote developing nations, they still do a lot of agriculture. Now they're doing less, but the whole point it's trying to say here to establish the history is that, you know, developing nations, they usually start off farming, mining, you know, the high-tech industries that we discuss. It's not as easy to create, and if you did want to do it, you needed capital, you needed money, and that wasn't always attracted, especially if you're starting off and then competition and you could go elsewhere, yibbity bobbity boo. So continuing, a similar pattern is evident in the commodity composition of developing country exports. In 1962, developing country exports were heavily concentrated in primary commodities, agriculture products, minerals, and other raw materials. Roughly speaking, in each developing country, primary commodities accounted for more than 50% of exports, and in more than half of the listed countries, primary commodities accounted accounted for more than 80% of exports. In addition, each country exported a narrower range of primary commodities. Some countries were mono exporters, that is, their exports were almost fully accounted for by one product. For example, more than 80% of Burundi's export earnings came from coffee, and cocoa accounted for 75% of Ghana's export earnings. Similar patterns are evident in Latin America. In 1950, coffee and cocoa made up about 69% of Brazil's exports, and copper and nitrates constituted about 74% of Chile's exports. The structure of these economies and the composition of their exports thus underline the central point. Developing countries are abundantly endowed with land and have little capital. The precise form through which landowners dominated politics prior to World War II differed considerably across regions. In Latin America, an indigenous landowning elite dominated domestic politics. In Argentina and Chile, for example, the landowners who controlled the government, often in alliance with the military. Even though these political systems were constitutionally democratic, participation was restricted to the elite, a group that amounted to about 5% of the population. In a system that has been characterized as an oligarchic democracy in other Latin American countries such as Mexico, Venezuela, Peru, dictatorial and often military governments ruled, but they pursued policies that protected the interest of the landowners. With landowners dominating domestic politics, Latin American governments pursued liberal trade policies that favored agriculture production and export at the expense of manufactured goods. As a result, most Latin American countries were highly open to international trade, producing and exporting agriculture goods and other primary commodities, and importing manufactured goods from Great Britain, Europe, and the United States. In Asia and Africa, export-oriented agriculture interests dominated local politics through colonial structures. In Taiwan and Korea, for example, Japanese colonization led to the development of the enclave agriculture, that is, export-oriented agriculture sectors that had few linkages to other parts of the local economy. Agriculture producers bought little from local suppliers and exported most of their production. In both countries, agriculture production centered around the production and export of rice. In Taiwan, sugarcane was a staple crop as well. India produced and exported a range of primary commodities, including cotton, jute, wheat, tea, and rice. In exchange, India imported most of the manufactured goods it consumed from Britain. In Africa, colonial powers encouraged the production of cash crops and raw materials that could be exported to the mother country. In the Gold Coast, the cocoa industry was a small part of the economy. In 1870, under British rule, Ghana became the world's largest cocoa producer by 1910, and cocoa accounted for 80% of their exports. In Senegal, France promoted groundnut, the American peanut, production, and by 1937, close to half of all cultivated land was dedicated to this single product. Similar patterns with other commodities were evident in other African colonies. So I'm pretty sure it's going to explain it here, but I hope you guys are getting it at some point. You know, we're trying to figure out why did we get to this import substitution? Why do these countries import certain things? And just like America, man, I mean, this isn't, a lot of people like to blame, you know, America in the early days and all this other stuff. And again, this is just my opinion, but what it's showing is that over history, anybody who was in control, the landowners, it doesn't matter, Latin America, Africa, America, these landowners, those were the ones that promoted certain policies. And in these developing nations, the big guys, they were all agriculture, they were all commodities guys. These were the guys who said, no, well, we have power, let's consolidate that power, let's use our landowner and all of this to promote these policies. And what it ended up doing over time is kind of creating a system where they focused on selling their cash crops and what they're good at, and then just importing everything else that they needed, because some people did want to preserve it. So now you got to ask yourself, state-centered, society-centered approach. You see how we got here? So continuing, these political arrangements began to change in the early 20th century. As they did, the dominance of export-oriented interests gave way to the interests of import-competing manufacturers. In many instances, the most important triggers for this change originated outside of developing societies. In Latin America, international economic shocks beginning with World War I and extending into World War II played a central role. Government-mandated rationing of goods and primary commodities in the United States and Europe during the two world wars made it difficult for Latin American countries to import import many of the consumer goods they had previously purchased from the industrialized countries. In addition, falling commodity prices associated with the Great Depression and the disruption of normal trade patterns arising from World War II reduced export revenues. The interruption of normal Latin American trade patterns led governments in many countries to introduce trade barriers and to begin producing many of the manufactured goods that they had previously imported. The rise of domestic manufacturing, in turn, produced a growing urban middle class as workers and industrialists began to move out of agriculture production into manufacturing industries. So if you're not getting it so far, it's like we started off one way, and it was because of these landowners, and then where did the shift happen? Think about it. The World Wars and Great Depression started happening. America was like, oh, well, we have to actually start reserving our stuff now. We can't sell you the stuff we were selling you before. All this stuff these countries would import, now they have to either make it themselves or not. And then the normal stuff people would buy because of the war and Great Depression, that started to change behavior. So now these guys are like, man, we got to start making our own stuff now. So continuing, the emergence of manufacturing industries gave rise to interest groups, industry-based associations, and labor unions that pressured the government to adopt economic policies favorable to people working in the import-competing sector. The creation of organized groups to represent the interests of import-competing manufacturing generated its own political logic. On the one hand, the groups that saw their incomes rise from protection had a strong incentive to see protectionist policies continued in the post-war period. On the other hand, the emergence of new organized interests and a growing urban middle class created an opportunity for politicians to construct new political coalitions based on the support of the urban sectors. In Argentina, for example, Juan Perón rose to power in the late 1940s with the support of industrialists and the military. A similar pattern was evident in Brazil, where Getulio Vargas was elected to the presidency in 1950 with the support of industrialists, government civil servants, and urban labor. Nor were Argentina and Brazil unique. Throughout Latin America, post-war governments were much less likely linked to landed interests than governments had been before World War I. Instead, governments rose to power on the basis of political support from interest groups whose incomes were derived from the import-competing manufacturing. Such governments had a clear incentive to maintain trade policies that protected those incomes. So it's describing the shift in what went from the landowners, they had the land, they had the power, they got all of their stuff voted through and all of that. Well, then you get protectionists, creates a new industry of winners and losers, specifically winners. Now you got people advocating, and then that's where they start making their political advancements and rise or shift away pretty much from only having a government represented by the landowners and their interests. So continuing, a similar dynamic is evident in India. The global economic collapse of the 1930s forced India to become increasingly self-reliant. Markets for Indian exports constricted sharply, thereby greatly constraining Indian export revenue. Unable to earn foreign exchange, India had to reduce imports of manufactured goods as well. Under the forced self-reliance, India began to create an indigenous manufacturing sector. By the end of World War II, India had emerged as the 10th largest producer of manufactured goods in the world. The indigenous urban manufacturing sector then fused with the burgeoning nationalist movement during the late 1930s to lead the push for Indian independence and to supplant the predominantly foreign-owned export sector of the center of Indian political system. By the time India achieved independence in 1947, it was committed to a strategy of autonomous industrialization. In Pacific Asia, the shift in political power came abundant as part of decolonization. In Korea and Taiwan, political change resulted from the defeat of Imperial Japan in World War II. In South Korea, Japan's defeat transferred power from a foreign colonizer to indigenous groups. Although landowners initially dominated post-war politics, the Korean War of the early 1950s and a series of land reforms implemented during that same decade greatly reduced the landowners' power and increased the relative power of the emerging urban sector. In mainland China, Japan's defeat was followed by the defeat of the nationalist Chinese government in the migration of the Chinese nationalists to the island of Taiwan. Once installed in Taiwan, the Chinese nationalists instituted land reforms to assert their authority over indigenous landowners and to prevent the repeat of experience on the mainland, where the rural sector had supported the communists. As in South Korea, land reforms reduced the power of landowners and increased the power of urban industrial sector. Oh, little Taiwan info for y'all. Oh, we're going to invade China, huh? So Africa's transition came later. Decolonization began only in the 1950s, and it took a slightly different form. The push towards decolonization was led by a coalition of indigenous professionals who had been educated by the colonial powers and then acquired positions in the administration of colonial economic and political rule. One factor motivating Africa's push for independence was dissatisfaction with the discriminatory practices of colonial administrations. Colonies were run for the profit of the colonists, with colonial economic enterprises staffed and managed by men from the colonial power. The local population had limited opportunities to participate in these economic arrangements other than as workers. The nationalist struggles for independence that emerged in 1950 sought to transfer control over existing economic practices from the colonial governments to indigenous elites. The period demarked by the start of World War I and the end of decolonization in sub-Saharan Africa thus brought a fundamental change to the patterns of political influence in developing countries. Political structures, once dominated by export-oriented agriculture interests, were now largely under control by import-competing manufacturing interests. Consequently, governments beholden to the import-competing sector had a clear incentive to abandon liberal trade policies and to continue protectionist arrangements that they had built during the 1930s. As we will see, the political interest in protectionism was reinforced by an elaborate theoretical structure that argued that protectionism was the only path to an establishment of industrialized economies. Oh, okay. And that is it. So that's the first part. It was a little long, but it's trying to let you understand here the multiple segments in history, again, of how we went from one area to another, what caused it, the natural endowments, having land, having certain things. It started one thing, and then as the world changed, again, think about globalization, we were trading with each other and doing a lot of stuff, and then World War I, World War II, then after like 1940 to like 1950, you had big shifts, and then you started getting the emergence of interest groups, and a lot of it, the crazy part, all of this stuff's fairly new. I mean, granted, I guess it's like 70 years ago, but if you really think about it, it wasn't until those periods though that we started getting this. But the idea here and what we're trying to understand is, why do we have import substituting? Again, why do countries choose to make one thing and import the rest? Why do they choose to protect one industry and not protect the other? And what is the main goal? So we will be getting to that. Again, hundreds of pages. I think we're like 130, 140 pages in, so we still got a lot more. But Chatadonia, I hope you're ready for all of it. But that is your watch list, ladies and gentlemen. Make sure you're healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, sacrifice the things that ain't easy for you. If it is easy for you, it don't matter. It don't matter. Do the one that's hard, baby. Think about it. Meditate, relax, and don't forget to be still, my friend. But Chatadonia, I'll see you in the AM. Drink that water. Stay hydrated, healthy, all that good stuff. And horn.